I'm here to go over 10 must-ask questions to ask your lender to make sure you get into the right product, get a great rate, and low fees. Also, I'm going to share a few secrets that they don't always go over with you, and I'm going to explain why. According to the Consumer Financial Protection Bureau, only 47% of homeowners actually shop more than one lender. So even if you only have one lender at the moment, at least these 10 questions are going to allow you to make sure that you're positioning yourself to be able to get yourself into the right product and a good rate. Number one is, do they do soft credit checks? Now, if they do only hard credit checks, it doesn't mean that you shouldn't work with them. However, you have to understand when you do a hard credit check, it is going to go ahead and hit your credit score and impact that. And you may not be looking to shop or purchase a home right away. And so they might have to do another hard inquiry depending on how long the actual process takes. With a soft credit inquiry, I can actually look at your scores, look at the debts that you owe, and still be able to get you approved to be able to go out there and start shopping for homes. So make sure that you understand the difference between the two and if the lender that you're currently talking to offers a soft credit pull. The second question you want to be sure to ask is, what credit score are you using to quote this rate? Credit score is going to be one of the biggest factors in impacting what rate you qualify for. And if they're using a score that perhaps maybe is a little bit higher than what you think it might be or what it's going to be, then it's going to affect the rate. Also, lenders, due to fair lending, they actually have what they call like credit buckets, meaning that people fall into credit buckets. So for example, everybody from 660 to 679 with a particular lender all will qualify for the same rate given all other factors of the loan are the same. 680 to 699, 700 to 719. So if you're on the borderline of being at like 719, you're only 1 point away from getting a slightly better rate or slightly better fees for the rate that you're qualifying for. And this is where question 3 really comes in handy and is huge, is will the lender do a rapid rescore if they could potentially get you a better rate? So when we pull your credit score, we pull Experian, TransUnion, and Equifax. We get your 3 scores, but underneath each score, it might say plus 40, plus 10, plus 15. If we click on those plus, and then we say request rescore express, it's going to actually map out in detail how we could potentially raise your score within just a few days. So let's go ahead and take a look at a real life example. This was a borrower that I actually helped purchase a home. You can see that the middle score of the one borrower was 757, so they were just on the borderline of being able to get to 760. You can see that it found a way to get above 780 with 96% likelihood. With 2 accounts, it would only utilize about $823. The borrower actually took the directions, then they supplied me with the documents, I submitted them, and within 2 or 3 days we got the new score, and that new score was 792. So before the rapid rescore, when we were utilizing 757, this was on a jumbo loan for the rate that they were qualifying for, the lender was going to charge them a little over 1 point in origination or discount points, which was $12,410. Once we got their credit score above 760, the actual discount points went down to $6,115 for the exact same rate. The only difference was that we bumped the credit score, only utilizing 2 accounts and $823. This saved these borrowers $6,294 in upfront costs for the loan. Now, some lenders or brokers don't actually do rapid rescores, and the reason is they actually can't charge you for the rescore. It's against the law. So we actually have to pay for this up front, and potentially we could help you rescore your credit and then you could go to a different lender. So a lot of banks or brokers don't do it because they could be potentially out that fee. So you can see for these borrowers up front, I had to spend $146.50. But at the end of the day, I was able to help save them around $6,300. So obviously it made sense. I helped close these borrowers and they gave me a great review. It's the right thing to do. And in the future, I know potentially when rates drop, who are they going to come back to for a refinance? So make sure that you're working with a lender that will not only tell you about a rapid rescore, but then offer it to you if it's something that would benefit you to be able to go into the next credit bucket. The fourth question you want to ask is the lender charging discount points for this rate? So I don't want to get too into the weeds about discount points, but essentially when you're actually qualifying for a mortgage, there's usually what they call a par rate. So a rate where the lender would not have to charge you any additional fees for that rate or discount points. And then there's other rates below that, and they would actually charge you an additional fee to be able to get that rate. Now, if you're just talking to a lender and they're quoting you a rate, sometimes they don't actually go over what the discount points would be for that rate. So I might quote you, 6.5%, and they're quoting you 5.99%, but there's actually a fee to be able to get the 5.99 versus the 6.5, there might be no fees. So make sure that you ask them, what are the discount points for the rate that they're quoting? So the only real difference between lenders is Section A of the loan estimate, where we're talking about origination. So it's not only the discount points, but also what are they going to be charging for underwriting fees, origination, or any other junk fees that are going to be in Section A of the loan estimate. If you're putting less than 20% down on the loan, then you are going to have private mortgage insurance if you get a conventional loan, and that can vary from lender to lender. So even though two lenders are quoting you the same exact rate, the actual PMI, the monthly amount that you're going to pay to be able to get the insurance for that loan, can be very different between lenders. For example, I have 4 lenders below. I priced this out, and each of these are quoting 6.75. However, one lender has $120 a month for PMI. Another lender has $170. So it's a $50 difference per month in the actual payment. So you want to make sure that even potentially if the rate is lower but their PMI is higher, the total payment might be more for that lender. You also want to ask if the lenders offer a 2-1 buy down. Now, this is something in a market where rates are high that might be advantageous for you. It's not right for everybody, but at least you want the option to be able to do it. It's something that the actual seller would pay for. And essentially what it means is if the qualifying rate is, let's say, 7% in today's market, that means the first year your interest rate would start at 5%. The second year your interest rate would be at 6%. Then the third year would be at 7% for the remainder of the 28 years on the loan. That gives you 2 years to potentially have rates fall and to be able to refinance before you get to 7%. And if you work it right in the actual sales contract with your realtor, we can get the sellers to pay for that fee potentially. Another important question to ask is when you can lock the rate. Most lenders, if it's a purchase contract, will allow you to lock once you go under contract for a property. Now, there's also options where they say you can lock and shop, but a lot of times that rate's going to be higher because they're giving you, let's say, a 120-day window to go find a property. So they're actually hedging against the fact that you're going to go out there and shop. You got to remember with mortgages, at the end of the day, these are all investments for other people. They're buying these mortgage-backed securities. So anytime that they're potentially risking the fact that rates might go up over a period of time, they're going to pass that on to you on the front end of this. So even though that they may allow you to lock and shop, you ought to understand what that actually means and what that would be comparatively speaking to where if you were only under, let's say, a 30-day lock, a lock that happens actually once you go under contract. When you're talking to the lender or a mortgage broker, asking them, is this a pre-qualification or a pre-approval? And there is a difference. So with a pre-qualification, you're going to talk to me, I'm going to obtain some information, maybe you give me some documents, I can review them as a mortgage broker and I could issue you a pre-qualification letter. A pre-approval is much different because it actually goes to an underwriter and they actually review the documents and make sure that your income works, your debt to income ratio. It is a full approval. The difference is when you give the actual documents to potentially a mortgage broker or lender and it's just a pre-qualification, if they actually haven't been submitted, your income might change. Okay, if you get commissions, you work variable hours, you get bonuses, etc. If they don't calculate that exactly right, they could be off. That's why it's really important that your actual income gets approved by an underwriter to make sure that we're exactly right, especially if your debt to income ratio is close to the max. So that's why it's really important to ask, what is your debt to income ratio? If they tell you that you're at 45% or close to 50%, you want to know that because potentially is there a way for you to pay down some credit cards to make sure that you're not that close? And if you are that close, then that means whatever approval that they're giving you is your very, very max budget. Are you comfortable with that? And then also, they're doing the max payment, but are they considering any association fees if you're going to purchase a home that's inside of a homeowners association, or if you're looking at a townhouse or condo that has association dues? Once you add that into the payment, that might take you over the debt to income ratio threshold. Some other tips and questions that I recommend to you. If you are shopping around for rates, make sure that you get the quotes the exact same day around the exact same time, because rates do move. If you have me quote you today and then you wait 4 or 5 days, potentially rates have shifted and moved. Remember, these are moving targets, and potentially something in the economy could have changed. A jobs report comes out, something happens, and now either rates got worse or better over that period of time. So what you want to do is make sure that you're quoting on the same day. So whenever you're going under contract or you're putting in an offer, you can send it to 1, 2, or 3 lenders, the exact same scenario, and just say, hey, based on today's rates, what would be the rate that I would qualify for, and what would be the discount points and the origination for that rate. Make sure that you do a quick Google or a Zillow review on the actual lender and see what their reviews are. If they have a lot of 5-star reviews, obviously you can probably be pretty confident they're going to do a good job for you. But again, it's something that's really easy for you to just look up. Now, one thing is that a lender could have a lot of 5-star reviews, but does the loan officer that you're actually working with have a lot of 5-star reviews? So you want to make sure that that individual has their own reviews as well. When you were on the phone with the actual mortgage advisor, did they offer you options? If really they just went over a specific product and a rate with you, unless you're, a high income, high credit borrower, you're really only going to go with a conventional loan, maybe you're putting 20% down, there's really only one type of loan that you're going to be put into. However, if you're a first-time home buyer, you're putting, the minimum amount down 3% on conventional or 3.5% going FHA, and they're not going through your different options and also quoting you multiple rates with different fees associated to show you the different monthly payments, then in my opinion, they're not doing the right job for you. And also they're not meeting lender requirements by giving you a certain amount of options, because they're basically steering you into a particular loan. And lastly, if you're shopping online, you're Googling rates today, mortgage rates, those types of things, make sure that you read the disclaimers. So in this example, this is one of the larger lead providers in the country for mortgage loans. They actually provide your lead to multiple different companies, and you can see that they're advertising rates as low as 5.2%. That's what they're hoping you look at. You can see obviously the font is huge. That way, if you call me after you spoke with them, you probably already have in your head 5.2%. But what you're not understanding is what they're actually marketing. So you can see that it says advertising disclosure there. And so if we actually click on the advertising disclosure and we pull this up, you can actually see that this is for a 15-year fixed loan. So not a 30-year fixed loan. It's for somebody that has a 680 credit score plus, a single family residential home. So not if you're looking at a townhome, condo, modular home, something else, that it's owner occupied, that the home is located in Pennsylvania, and that it's at 79% LTV. So meaning that you'd be putting like 21% down if this was a purchase. Now they're detailing out a refinance, but you get my point here, is that they're not quoting the actual 30-year fixed rate. You can also see that the points at the bottom, it says 1.93 points in this are fees of $12,031. So to be able to get the 5.2%, you got to be at 15 years and you're going to pay $12,000 in discount points. So pretty misleading, but it's just there to be able to obtain your information so they can turn you into a lead and then hopefully hand you over to a lender that will convert you into a loan. But at the end of the day, they're just a lead provider. And that can be very confusing when you're in the marketplace and you're searching, because it really looks like you're getting presented a 5.2% rate. So the most common mistakes I see borrowers make when choosing a lender is failing to shop or interview lenders. I know a lot of you don't want to have to talk to multiple people getting the same spiel. Some people are very salesy over the phone, or maybe you feel like you're going to get pushed into something. At the end of the day, your mortgage is going to probably be one of the largest investments you've ever made. And you're not really going to be able to be pushed into anything, because at the end, you have to be able to purchase that property. So what I would suggest is talking at least to 3 people, whoever you can kind of build the most rapport with and trust. Then eventually that's probably who I would at least get approved with. And then at the end of the day, once you go under contract, if potentially you want to just make sure that they're still quoting you a solid rate, you could always reach out to somebody else. Another common thing I see is working with a realtor's preferred lender. Now, sometimes that realtor can have a great preferred lender, And sometimes it's more just they're confident that that lender can close, but that doesn't mean that that lender has all of the best options for you. Not every bank has the same qualifications as each other, meaning that some banks, they both offer FHA loans, but one bank only goes down to, let's say, 600 credit score, the other one goes down to 540 credit score on FHA. And so one might deny you, and the other one can get you approved. There's a lot of different things that can go into it, so even if your agent tells you that this is the best lender, I would still highly recommend that you at least talk to 3 people. We already kind of talked about when you're searching on the internet, but if you're only relying upon that, make sure that you are doing your due diligence, 1, on looking up reviews from third-party companies like Google and Zillow, and then 2, that you're reading any disclaimers about the actual rate itself and what fees they're going to charge. And then lastly, not asking questions. If you ask the 10 questions that I provided to you, you'll at least position yourself to be able to make sure that you're in the right product, most likely getting a good rate with low fees. Let's talk about what a loan advisor should do for you. First of all, they should review your credit report thoroughly with you. Make sure that there's no errors on it, and also make sure that the actual balances and minimum payments on the credit cards are accurate. I talk to a lot of borrowers that put everything on their credit cards monthly, but then they pay it down to 0 each month, but that's not what reflects on the credit report. So there's a minimum payment due, which can impact the debt to income ratio, which can impact how much loan you qualify for. So if you actually do pay that down to 0 each month, we can document that, we can get that debt removed, and then we can potentially get you approved for a higher loan amount. Did they talk to you about your long-term and short-term goals? If you're potentially moving into a starter home and you're going to move in a few years, then it wouldn't make a lot of sense to pay any discount points for the actual loan or rate unless you had to for debt to income purposes. There's a lot of other factors that go in depending on what your goals are, so they should be asking you those types of questions. Is the lender or broker that you're working with going to call the listing agent when you actually submit offers? One of the main things that happens is you put in offers. If you're in a multiple offer situation, the listing agent and the seller are going to most likely obviously accept the offer with a high price, but also with somebody that they feel is confident that they can close on the loan. So if your lender actually calls them up and says, hey, I've reviewed their income, I've looked at the documents showing the down payment, we've verified all of these things, this is a very solid borrower, you can be assured if you accept their offer that you have a solid deal on your hands, you're much more likely to be able to close on that property. The mortgage broker or lender should prepare you so you're not scrambling. You know, a lot of times a 21-day escrow, 30-day escrow, it sounds like a long time, but with everything else you have going on with the property itself, appraisals plus your own job, all these things that are happening, it goes very, very fast. And so if we don't prepare you and we don't have the documents ready, it can really become overwhelming quickly. And then we can start running out of time and it becomes very, very stressful at the end. And then we may not close on time, or it's just a super stressful process for you, which we don't. So if we can tell you everything up front, which we should know, and get you ready, then at that point, the whole entire process can be a lot less stressful. Sometimes it does happen where properties don't appraise for the actual value that we're looking for. And so you want to work with a lender or mortgage broker that can look at that appraisal, work with the realtor, look at other like properties that have sold, and see if we can get the value actually raised by showing them, hey, yes, you use these comparable properties, but we actually have these ones as well. These ones are closer. These ones are more like property that we're looking at right now, and potentially we can get an actual value raised. Even if it's not something that they get raised, at least you know you have somebody on your side that's looking out for your best interest, so you can either walk away from that property or potentially renegotiate. Remember, we should never be steering you into a loan, so you should be presented multiple options and solutions to any issues that you're running into. And lastly, a lot of times we'll give you a pre-approval and say, hey, you're pre-approved for up to 700, 800, 600,000, whatever the number is. But are you actually comfortable with that payment? Does it fit your budget? So make sure that you're talking to somebody that actually goes over with you what the total payment will be, also what the total cost will be for the actual, not only down payment, but closing costs, all these different things that a lot of first-time home buyers don't realize that start to add up, like homeowners insurance, property taxes, title, escrow fees. All of these things, if you're not prepared for it, can come and shock you once you're under contract. And that's not the time that you want all these additional pressures. So when you're going to choose a lender, make sure that you consider their online reviews and reputation. Do they do a soft credit check? Are they going to do a credit review with you? Do they actually do a consultation with you and go over your long-term and short-term goals, all of your options, or are they pretty much just sending you an application link? Do they do rapid rescores to potentially put you into a better credit bucket, which could get you a better rate or lower fees? Will they call the listing agent? And do they work only 9 to 5 Monday through Friday? If they're working at a bank or a credit union, you're most likely not going to get a hold of that person on the weekend. That's a lot of times when you have to turn in your offers. So they wouldn't even have the ability to call the listing agent outside of hours when they're closed. At the end of the day, my goal is to make sure that I give a 5-star experience. And these are just some of the reviews I have on Google and Zillow. So you can read them yourself. Make sure that the lender or person that you're working with also has reviews for you to be able to go through. Now, if you want to learn more or you have additional questions, if you want to see what you can qualify for, go ahead, you can scan this QR code. It'll get you to my direct calendar, or you can go ahead and text me at 619-404-6637 or give me a call, or you can shoot me an email at trevor@rebrokerbuddy.com. If you're already working with a lender and they've already provided you a loan estimate, if you email it to me, I can go ahead and review it to you, let you know if I can potentially get you into a better rate with lower fees. I hope this was helpful for you. If you could, go ahead and give it a like. You can go ahead and comment below. And I do have other videos that go into more details about each of these sections to make sure that you're informed as possible when choosing which lender you want to work with.